Well, good afternoon, everybody, from sunny Sydney, and welcome to Angel Investing 101. My name is Philip Argy, and I'm going to be entertaining you for the next 50 minutes or so. And just a quick outline of what we're going to cover. We're going to cover this gap between what I call family, friends, and fools, and serious venture capital and angel funding. So we're going to look at the early stage ecosystem as well, and we're also going to look at what the angel investing sweet spot is, as I call it, the private capital journey, and then a little bit about Sydney Angels, because what we do is perhaps a little different from what a lot of other angel investment groups do. And then hopefully we'll have plenty of time for Q&A to talk about a whole pile of things. So let me just see if this remote clicker works, this gadget. So far not, but let's see. Oh, there we go. So what makes an angel investor tick? Who are they? How do they behave? What does active, not passive, even mean? What are the other drivers? So look, in a nutshell, an angel investor is a high net worth individual, somebody generally who's had a fair bit of success in their past life, in their career, or with another investment, or indeed as an entrepreneur, and they've sold out and had a great exit, and now they're ready to help others. The thing about angel investing is we call it smart money. And that's the difference between active and passive. You could go and put all your money on the share market. You could go and put it on a horse, for that matter. Angel investing is quite different. It's where somebody has a genuine interest in the subject matter of your invention, or whatever the product is that you want to sell, or the service you want to provide, or the software you've created. And they like to be hands-on, certainly during the initial stage, but not in some micromanaging way. Angel investors love to be a resource, a sounding board. You've generally got, as I say, people with a lot of commercial experience, pretty wise in the ways of the world, if you like, generally fairly canny people. And that's a fabulous resource that you really do want to draw on if you're an entrepreneur. And if you're another investor and you haven't had a lot of experience in the field, joining up with a group like Sydney Angels, where you can work with on a team with really experienced angel investors, is just a terrific experience. And I'll be saying a little bit more later about the way Sydney Angels in particular operates, because as I say, we have our methodology. But the general motivation for being an angel investor is just this giving back, sharing of knowledge, staying connected with, Aussie innovation. I get up every morning and just absolutely love what Aussies get up to. We are, I think, per capita, the most innovative people on the planet. We've turned the tyranny of distance into the mother of invention. And indeed, the tyranny of distance has worked to our advantage. Obviously, for COVID, we can become Fortress Australia, and whilst internally we have some issues to deal with, boy, aren't you lucky we don't have land bridges to some of these other countries. But it's very satisfying mentoring young entrepreneurs. You can fill any role. You can be a therapist, a coach, a giver of tough love. A little bit paternal sometimes maybe, but it really is a team thing. You get together with your fellow investors and you are all barracking for the team, and the team is whatever you've invested in, and you will want it to work. And it's that energy, that dedication, that focus on making it work that in fact gives it the best chance of working. And if it's not going to work, well, you want it to fail early, basically. So you can have some moonshots, as we call them, although we call them moonshots, but I think soon they'll be called Mars shots, maybe even Venus shots, if I'm really up to date. So where are angel investors and where do you find them? That is a bloody good question. They are hard to find. They don't generally just put their hand up and say, here I am, because that might be inviting, unintended consequences. So again, there's safety in numbers at Sydney Angels. You can come along to Sydney Angels and be an investor. We find you all the fabulous deals. As I say, you work with some fabulous people and you get on a team, and team-based investing is the real name of what we do. Right, my clicker is very, very finicky. There we go. I don't know how easy that is to read. I can hardly read it, but it's designed just to give you a little snapshot of what the Australian ecosystem looks like in the startup space. It ranges from incubators, it ranges from venture capitals, it ranges from other angel investing bodies around the country. So it's it's getting a very crowded space. Indeed, speaking of crowds, you've got crowdfunding as well has now entered the picture. So there's a lot of different sources of funding for startups. They're not all identical to angel investing, although some are competing, quote unquote, in that space. The other thing I quickly want to add, because it's something we're often asked, people often ask me, it's so hard to get funding in Australia. If we go over to the US, say Silicon Valley, I can get $10 million. People don't realise, in Silicon Valley, you can be walking down the street in Palo Alto and someone will jump out of the shadows and shove $10 million in your face, which is fabulous, and then they'll tell you they want 10 times their return on that in the next 2 months, and they'll murder you if you don't deliver. It is completely stupid money. You can get as much of it as you like, and it will drive you nuts. We, on the other hand, being smart money, are not going to give you anywhere near that much. We'll give you as much as you need, and we'll dribble it out as and when you meet milestones, and we will help you use the cash, our cash, with the right discipline. So you are continually focused on the next milestone. So we'll certainly promise you the funding you need, but you'll get it in tranches as and when you need it, so you don't go berserk, and that's for your protection as well as ours. So we just do things, as I say, a little differently. And that's another sort of view of it, again, because I can't read it on the screen that I've got here. I'm going to skip over that. You can get that when you get the slide pack. The private capital journey is important. It shows what the returns you can expect at different stages. So if you start right down the bottom, the real seed, that is from scratch, from a blank sheet of paper, that's really your cash, or your family's cash, or the fools that want to jump in that early and give you some cash. They potentially can get very high returns because the valuation is very low. It's very low because you've got no basis for valuing it yet. So then you come up to angel investing, and you'll see you've already halved your potential return from 20 times your investment to around 10. These are rough averages, though. I mean, it could be 30 or it could be 2. 10 is just an average of 2 numbers or multiple numbers. And then you come to this diagonal line, the risk-reward line, where we have what's called Series A. So Series A is your first serious capital raise after you've effectively de-risked for the most part. And the reason you've crossed that risk-reward barrier at that point is that until then, you've got a little bit of traction. Hopefully you've got some indications from the market that they like your product. You've certainly built by then a prototype, if not in production. But by the time you get to Series A, you've got serious revenue, you've got sales, and the market has voted as to whether they like the look of what you've got. From that point on, it's not free of risk, but you've passed the point where you're going to be rewarded with a very big multiple for your investment because the risk has been very much minimized. And on top of that, the valuations, of course, are significantly increasing as well. So as the valuation goes up, the multiple necessarily comes down. So that's just to give you a bit of a feel for what that looks like. And of course, by the time you get to an initial public offering or some kind of merger and acquisition with somebody else, you've definitely taken away the majority of the risk, and you're not going to get massive returns. So if you wait too long to invest, like everything, the lower the risk, the lower the return. So angel investing is objectively a high risk segment of your portfolio. So there's no point pretending otherwise. Of course, you can get great returns, but you also are at high risk of losing a lot. Um, this slide just gives you an idea of how things have matured. If I go back probably even 6 years, you had a relatively small set of sources of funds. You had the angels, and you had your families, and you had a few bits and pieces. But now you've got equity crowdfunding, and you've got wholesale and retail crowdfunding. You've got family offices who've certainly increased their interest in the space. You've got formal early stage venture capital structures, and including ones that governments give lots of concessions to, and so on, without going through all of those there. So whilst at one level there's a lot of people competing to give money and to invest, angel investing is still a definite carve out and a definite segment. Um, so let's, gosh, this clicker is very temperamental. So what are the stages of growth? This slide is really, if you like, the life cycle of an entrepreneurial company. So you start off at that startup stage, and you progress to the early expansion, and that's really where the angels will come in. Some of the early stage VCs, some of the crowdfunding will come in at that stage, but really if you like, the point that coincides with where we crossed the risk-reward line in that earlier diagram is at this expansion stage, where you've got a lot more venture capital availability, and then you're starting to move up into more serious later stages with much larger amounts of investment. So if you look down the bottom there, the average sort of investment early on is, chicken feed. You get up to 100 grand, 200 grand. Get into the angel level, we generally are looking for between $500 and $2 million to invest, and that's for somewhere like 40 to 50% equity. And then as you go up, obviously you've got less equity to give away, but the valuation has increased and you want more money. So you've really got to, if you're an entrepreneur, stage it carefully. And if you're an angel investor, importantly, don't put all your money in at the early stage. Yes, the more you put in at the early stage, the more you'll get back if it's a success. The more you'll lose if it fails early. But of course, the big danger of putting too much in early is you'll get diluted. So as more and more rounds and more investors come in, you'll get quickly diluted if you haven't put enough in reserve for this deal to match each round as it comes up. So you want to keep up with each new round so that you preserve your proportion of equity, and that's the best way of protecting each successive tranche that you put in. Okay, so we've got here your the different kinds of angel groups, individual angels, angel groups, and then sidecar funds. Um, and I'll help position Sydney Angels. Just bear with me for a moment, guys. I'm going to have to open this PowerPoint on another screen on my computer because these slides are just too small for me to read. I'll just see if I can change the view here. No, that goes the other way. Okay, bear with me. I'm just going to open the PowerPoint on my computer because it'll be quicker and easier to do that. Sorry about this. This is all because of my vanity that I wouldn't let you see my messy office. So bear with me. I've got painters painting around me. I've got all sorts of things happening. Okay, so as I say, if you look along the bottom there, we've got lots of different stages, and we have got the different forms of investment. I'm just going to advance this now so it keeps up with you. Okay. Now that looks like we've got just back one. Have I gone forward two? Okay, it's gone forward 2 slides. Okay, that's all right. So this is to tell you a little bit about Sydney Angels. So we're an angel investor membership organisation. We've been around now for about 12 years. And as I foreshadowed earlier, the thing we do a little bit differently is that we have what we call a disciplined, team-based investment process. Essentially what that means is that we help our members invest more efficiently and effectively in Australian startups. So we source quality deals. Those of us on the committee probably see something like 40 to 50 deals every month, and we cull those. We have 6 cycles a year. For each cycle, we cull the best 6 out of the 40 or 50 a month that we see. Those best 6 go through to what we call a deal screening meeting. At that deal screening meeting, the 6 entrepreneurs present for 10 minutes, and then there's 10 minutes of Q&A. After that meeting, we pick the top 3. Those top 3 go through to a full members meeting. So we alternate between a members meeting and a deal screening meeting. That's why we only have 6 a year of the deal screening meetings and 6 members meetings a year as well. And at the members meeting, on average, 2 out of the 3 deals that are presented will find enough members interested to form a syndicate and get invested. So What's a syndicate? A syndicate is simply a group of members who saw the deal at the meeting, want to know some more. They form a syndicate, and then they go off as a standalone team. They use all of our resources, and we have a full-time person who catalyses the deal, that is, helps them get their due diligence done, prods them to move, get their act together, have meetings with the entrepreneur, get their questions answered. But there's a methodology that we follow through on how to do the due diligence for all different kinds of companies based on topic and subject matter. So it helps you make better decisions. Obviously our networking is pretty good, and we have a great education program as well for members. So we really do have it very nicely set up. Now if I just go over here. Okay, so this is where the Sidecar Fund comes in that was mentioned. We've now got two Sidecar Funds. The first one was fully invested, which means it fully invested, and it only had $10 million to invest. Then we formed a second fund, and that's the one that's current. So what does a Sidecar Fund do? It's basically a conventional early stage venture capital fund. But the investment committee, instead of simply independently choosing investments, only looks at deals that 3 or more Sydney Angels members have put more than $50,000 of their own money into. So the reason it's called a sidecar is, like a good motorbike sidecar, it goes with the motorbike. So the Sydney Angels are the motorbike. We do the due diligence, so we have to satisfy the Sidecar Fund investment committee that we've done a decent due diligence. We haven't just, sucked our finger and said, this one looks pretty good. There's some rhyme or reason to it. But that enables external investors who only want to passively invest to actually co-invest alongside our syndicates. It's proven very popular with self-managed super funds to put their money in, but as I say, it's a standard early stage venture capital fund. Its returns are tax-free for investors in the fund. The first one raised $10 million, and now we've got a second one that was fully invested, and that second fund has started co-investing since 2017, operating like the first one. So it's not full yet, but when it gets full, we will move on to another fund, start up a third one, because they really are extremely successful. All right, let's see if we can get this slide to advance again. There we go. So I mentioned that we have 6 cycles a year, and we get 40 to 50 new deal applications online through a platform called Gust. If you go to gust.com, you can see the kind of things that are there. So basically anybody who is looking for investment funds for their new product or service or idea can go onto Gust and put up the details. Our application form is also done via Gust. So we are, if you like, there's a Sydney Angels subset in Gust, if you like, where people who apply to us get the same platform, but their deals are visible only to our members unless we release them outside. So the committee reviews it, as I said, and we filter them weekly. We take the top 6 to go to the deal screening meeting, then to the members meeting. Then we have our syndicate teams who do their due diligence, go through our investment process, and normally, as I say, 1 to 2 out of every members meeting. So that tends to give us 6 to 8 new investments a year. Occasionally, if you've had a good year, it could be to 10. The COVID year is just a little bit slower this year. There's less people putting in applications. But so as at end of September, we had 73 companies in our portfolio, which is pretty neat. And I'll just, if I can get this next one to come up. There you go. So Typically, we invest in their post family friends and fools round, 200 to 600,000. Sometimes we have co-investors, so there are other angel groups around the country. There's Brisbane Angels, there's Capital Angels, there's Melbourne Angels. So there's a whole lot of angels. There's angels in WA and in South Australia. I think the angels are still in WA. I'm not sure if we're allowed to talk to them yet, or if they've seceded. But so this is what it looks like. So if you have a look at the pattern, it's quite interesting. If you go back to 2008, this is obviously just our experience. The co-funding contribution, or co-investors, if you like, have waxed and waned a little bit. We've got our Sidecar Fund and we've got our members. So at first blush you would say, gosh, that's a low proportion for your members, but bear in mind we are the active elements of the investment. So whereas we might invest, say, $50,000 in a deal each, and so you might have, let's assume you've got 10 members each investing 50,000. That's $500,000. The Sidecar Fund will match dollar for dollar, so there's $1 million. And then you can have co-investors. You can have other angel groups wanting to participate, depending on what the deal is and where it's based, and how comfortable people are investing in deals that aren't close by. Look, I have to say, my own kind of predilection, and maybe I'm just a little bit risk averse or whatever, I like being hands-on, and that means I will generally only invest in deals that are within about an hour's drive away. I like to be able to drive to wherever the entrepreneur is and sit down and have a chat and see what they're up to and shoot the breeze, scribble on the whiteboard. Whenever they want to bounce something off you, it's much better sitting over a desk having a sandwich or a pie or something. Nothing fancy in this space. Everybody is frugal, even the investors. But look, that's just my personal preference. But the way the world is moving, people are more prepared to invest in deals that aren't that close. So, as I say, I've invested in a couple of ones in Brisbane, despite my reasonably strict principle, just because there's enough people who think it's a good enough deal, and you can watch it and follow it online. It just happens to be the kind of deal that you can be close enough to online, and the entrepreneurs you can have Zoom calls with. So, the remote communications has actually opened it up a little bit in terms of making people more comfortable investing further afield, because you can still have these intimate discussions with your entrepreneurs. But so that's a bit of a profile. We had a pretty funny year in 2013 where we just had it just so happened that we had a whole lot of co-investors come in. But we've been reasonably stable. That's a pretty accurate reflection of what it's like up to 30th September this year. Okay. If anybody offers you internetclicker.com, say no, because it's just a nut of an application. It takes about 8 goes of the pusher. You'd think it would be simple. Probably can't see that. That's all I see on my phone, but be good if it worked. Okay, we've got a slide advance. Fabulous. So we do filter our applications pretty rigorously. I mean, I have to say, out of the 40 or 50 a month that we get, they are really of very, very variable quality. You couldn't really put many of them to members. That's why we cull them down to 6. That 6 is generally pretty good. That's out of probably 100 deals we've looked at. So, as I say, you've got a 1 in 3 chance of getting invested once you get to a members meeting. And this graph shows the trend line. Again, that 2012, 2013 spike was just some aberration. I can't remember what caused by. Might have been people coming out of the GFC or something like that. But yeah, that was. We've been pretty consistent in terms of the percent of investments and the follow-ons and things like that. Okay, so what are the things we look at in our screening of deals? These are the four key things. There's subsets of those, but the market is obviously important. What's the target customer, the size, the growth potential, the competition, the go-to-market strategy, but above all, what are we looking for? We're looking for a credible business plan. Credibility is really important. We just want you to share with us as an entrepreneur why you think this is, the gift to the world and why people will invest. We don't necessarily need you to plot out the next 5 to 20 years, but we do want to really understand how you've arrived at your target customer, your assessment of competition, your go-to-market strategy. How have you arrived at it? And we just, everyone around the table decides if it's credible. We obviously want to look at what the type of business is, the performance, how do you differentiate yourself from others in the market, what's your secret sauce, what's your value proposition, what inspired you. All of these factors are important. Then we have a look at your team. What are the skills? What's the skills matrix on the team? What's their experience, their commitment, their balance? Again, I've highlighted credibility. Don't just come because somebody's told you that investors want to know when's the IPO or when's the exit. At the stage you're coming to us, it's a pipe dream to imagine that you'll have an IPO or even a major exit. That would be extraordinarily rare at this stage, and we don't expect that. All we want is a credible business plan on what are your proposed sales for next year, how did you arrive at that number, how are you scaling up the operation, how have you done the market testing, who's tried out the prototype. Just, basic questions that if you'd thought any investor sat down and thought about it for long enough could have all these questions on a bit of paper. The advantage you've got at Sydney Angels is we've been doing it for so long. We know all the questions for every kind of business. We know the sorts of issues to test on, and it's a very well-proven methodology that we deploy, and these criteria work for most everything. And you'll get different scoring, obviously, for different kinds of things. In terms of the amount and the terms, obviously, how much do you want? A sensible valuation. If you tell us that your accountant came up with a valuation, you're behind the eight ball because, with all due respect to accountants, they don't know how to value startups. They might be great once you've got a few years of revenue under your belt, but until then, they don't have the faintest idea. What's the rough time to exit? Having just told you that that's pretty unlikely you'll know that, but it'd be interesting to know what you think. And the potential returns, the dilution, the key people, is it a one-person band, and if that person falls under a bus, everything is dead? And yeah, did I mention credibility? That's still pretty important. Okay, let's look at the next one. So, the broad criteria for putting in your application to Sydney Angels is we want you to be either pre-revenue or early revenue. We don't expect you to be much beyond that. But certainly we want to have an understanding of why you think there's a high growth potential there. We'll look at most industry and technology sectors. We'd like you to be able to demonstrate at least a prototype product or service so that we can get a feel for what it is. We certainly want to see ownership of the intellectual property. We would almost never invest in any vehicle that didn't own the IP. A lot of people come along and say, I'm going to own the IP and I'll license it into the business. Yeah, like you'd need a hole in the head to put all your capital into a vehicle that didn't own the IP. So if it fell over, it's got no assets, not even the IP. That won't happen with anything that we invest in. Credible team, as I say, I've said less than 50 k's from Sydney, but to be fair, that is changing, and particularly with now people having a comfort level and the ability to chat like this pretty much anywhere on the planet, it does open up a little bit. But at the end of the day, we are still Sydney Angels, so if we're going to go external, particularly into other states, we'd like to co-invest with one of the local angel groups. Realistic valuations, as I say, most startups are looking at a pre-money first round valuation of say 1 to 2 million, perhaps even a little bit less, is okay. But really they're willing to offer members a minority equity position. I've said typically 10 to 20%. I must say I think it's probably a little higher than that. Really depends what stage they're at. If they've got some revenue, 10 to 20% might be fair. If they're pre-revenue, I think we'd be looking for more like 30 to 40% of equity. And unless they've got, a really exceptional product, or they're more established than usual and they've got a really strong team or very early market traction, we will really jump on high valuations because they just don't give you any headspace. There's no point in coming along and saying I'm an angel investment, and my accountant said to put a valuation of 8 million on it. I mean, where are you going to go? You're only raising a couple of $1 million on 8 million. That means you're already only offering 25% equity. What valuation are you going to be at when you go to your Series A and Series B? No one's going to invest because all you'll be able to offer them is like 2 or 3% equity. And at that level of investment, they can't really see much of a return on that investment for a long while. So valuations are really important, and coming in with too high a valuation, it's not that we don't love you, it's not that we don't love the idea of a high valuation, but you just leave everybody with nowhere to go. So you have to allow some headspace. It just doesn't work. You can't fill everything to the brim. So that's a link to our application form, sydneyangels.net.au, and you can do that at any time, and you just end up in whatever cycle you're in. Right now we've finished our last cycle for the year, so if you apply now, you're already in the first cycle for 2021. And the only reason for that, I know it seems like a long time, but no one does anything over Christmas, New Year, so there's no point getting in deals. There's no one to look at them. Investors aren't interested. They're all on holiday or they're off skiing, or maybe not this year, but who knows where they'll be. They could be up at Port Macquarie or somewhere. But we don't charge any fees or anything to apply, so it's a no-cost application. But we do ask you to put some time and effort into working with us through our team-based due diligence process. It's reasonably rigorous. We don't make any apologies for that. And again, because it's an individual investment, the individuals are still making their decisions. This is not Sydney Angels as a body investing. It's our members. We hold their hand, we give them resources and education, but at the end of the day, it's the ad hoc syndicate responsible for its own investment decisions, and if they're not satisfied with the due diligence, they won't invest. If the Sidecar Fund isn't satisfied with the due diligence the members did, it might not invest. So you just have to go through that exercise. All right, let me cover some of the pitfalls here. Don't be over eager for your first investment. If you're not an experienced angel investor, don't be afraid to hold back and watch, or just put in a nominal amount into your very first deal and just see how the syndicates work and how the processes work, and wait till you've been to a lot of our education workshops where you learn a lot of things. There's no point doing a poor or quick and dirty due diligence. That just increases your risk, and we are very strong on trying to teach you how to. You can't eliminate risk, as I've said. It's inherently a high risk segment for your investment, but it is an area where you can manage the risk sensibly. Don't accept a high valuation. I think geographic distance leaves you out of touch, but as I've said, zooming and stuff makes that a little bit more tolerable. Be careful before you decide not to waste money on a legal review, particularly if you've got existing investors and there's a term sheet that differs somewhat from the Sydney Angels recommended term sheet. We've put a lot of effort into getting a term sheet that's fair to everybody. It's fine to consider somebody else's, but unless you have some legal training or there's a lawyer as part of your syndicate, don't be too quick to say, oh no, we can't be bothered getting a lawyer to look at it. Don't over-allocate funds. As I say, just do it in tranches based on the next milestone. And in terms of, being a bit crass about it, when I say a high net worth individual, I mean somebody who is happy to put in money that they're not going to need in the next 10 years. So effectively be prepared to lose it, and even if you don't lose it, be prepared to not have any ability to get it back, not to be able to get that into any liquid form in the next 10 years. So, you're looking at a risk, you're looking at a committed funds, and just to balance it out, don't be obsessive. Once you've looked at the key things and you've formed a view, make a decision, and tell the entrepreneur. Don't keep them hanging on a string. If the majority of the syndicate is lukewarm, tell them that and move on. That's just how the world works. You can't expect people to hang around for too long. This slide is a little bit complex, but again, it really is just, I suppose, a way of quantifying what I've just said. It's maths, not magic. It's risky. There's a risk of dilution. The returns are asymmetrical. That is 70% of everything you invest in, you'll lose your dough, probably most of it. On average, you might get 2 to 2.5 times multiple. Only really 10%, if that. So 1 in 10 might give you a really good return of 10 times your investment or more. But like throwing a coin, you've got a 50-50 chance of getting heads or tails, but you might need to throw the coin 100 times before you get that average. You might get 25 heads in a row. It doesn't mean there's not a 50-50 chance. It just means you'll need another 70 throws for the average to come back. Or you might need 500 throws. Who knows how many times you have to throw to get your average. So when we say on average 1 in 10 will be a beauty, don't complain if your first 19 are abysmal and you lose your dough, and the next one you get back 50 times your investment. You simply don't know what's going to happen. You try and minimise your risk, you use your best efforts, but you just don't know. Here's some logos of the 73 that we've invested in. Some of those have become household names. We've got Venue Mob there, we've got SiteMate, there's a whole lot of ones there that are really, really fabulous. Some have listed, so you'll see there, if you can see, J-Ride has IPO'd, Ninja Blocks, we've put RIP. Don't be put off by the RIPs, because as I say, you can expect to lose. You should expect to lose your money in 8 out of 10. If you can't tolerate that kind of risk profile, you're not an angel investor. That's the blunt truth, and there's no point pretending otherwise. So 23 deals have already raised over $2 million. And Otomo, the one on there on the far left, again is fabulous. It only listed in April this year. Now I invested in that back in 2012, I think, so I've been in that for 8 years. It just happened to be in the right place at the right time. It's a little bit of a pathology lab on a stick. they had been for many years doing the testing um, for SIDS, um, and sorry, not SIDS, AIDS, um, all around the African countries. Um, they actually have a big investment from the Bill and Melinda Gates Foundation, which originally came in for AIDS, but they've been able to adapt the technology very quickly now to do COVID testing, and they've got approval from both the FDA and the Therapeutic Goods Administration in Australia. So that's really exciting, and as you can see, the funds raised are really good, and they're doing okay on the stock market as well. But again, that's just a handful of the ones that have created exits or had liquidity events um, so far. So that's 4 out of 70. So it's, as I say, you've got to be patient. Some have been really good launches. As I say, Otomo was about launching 10 times. At one stage, it shot up to 20 times for 2 days. I wasn't watching and missed that, but never mind. I'm still doing okay with that. Um, so we keep on growing. As I say, we've invested $29 million to date, which is pretty good. That's catalysed, if you look at how much the total raise is, those 73 startups between them have raised over $330 million. So effectively, our 29 million of seeding has already turned into 330 million. So that's pretty neat. That covers some grants, covers later round, it covers the Sidecar Fund, and it covers our members. So if you can see that far right column, you'll see it's 16 million directly from members' pockets, and 13 million from the Sidecar Fund. Sidecar Fund generally is dollar for dollar. There's a couple where members have invested that didn't reach the threshold of 3 members, 50,000, or there was a problem with the due diligence, so the Sidecar Fund didn't invest. But generally, the Sidecar Fund has a dual operation. That is, we have to save its space to match us dollar for dollar, and the other way around, we can demand it match us dollar for dollar, as I say, assuming that the due diligence is sound and we meet the threshold. So look, I might pause there. We are getting close to time, and I know people have always got lots of questions. So Patrick, I'm not sure how we are going to get the questions. Are they going to come to me through the chat or through the Q&A? Anything else we've got? Anything people want to ask? I'm happy if you ask them through the chat window or through some of the chat window. I think is best because I can see that on my screen. So I'll wait to see some questions. Otherwise, Patrick or Fabiano will tell me where to next. I'll pause there. I know time flies when you're having fun. Just while we're waiting for questions, I'll just promote the 20th of October session is a really interesting showcase of a select number of our portfolio companies. So if you're free at 7:10 p.m. on Tuesday the 20th of October, tune in to hear from the portfolio companies and hear what their experience has been as an investee of Sydney Angels. So, okay, Patrick's telling me no one's currently got a question. Come on, guys, you must have some questions. I was so good keeping to time to allow time for questions. Can we do a poll? Are we able to run a poll? No, we can't run a poll. All right. Well, we'll thank you for your attendance. I hope that's been of use to people, and feel free to send us any questions. So, okay, that's it from me. Thank you for your time.